If you're watching this video right now, there's a very good chance you're sitting on silver that you bought at 90 or 100 or maybe even 110. And right now, with the price at 84, every cell in your body is telling you to sell. Cut the loss. Get out before it drops to 70, to 60, to 50. The financial media is screaming crash. The charts look terrible. Your portfolio is red. And that voice in your head, the one that sounds rational, is whispering, you were wrong. Silver was a mistake. Sell before it gets worse. I need you to hear me very carefully. That voice is not yours. That voice was engineered. And in the next 14 minutes, I am going to show you exactly who built it, how they built it, and why listening to it right now is the single most expensive mistake you could make in 2026. Because here is what that voice won't tell you. Every single time in the last 44 years that silver has crashed 30% from a peak during a supply deficit, it recovered to a new high within 6 months. Every single time. In 1979, it crashed from 25 to 16 before exploding to 50. In 2010, it crashed from 29 to 19 before rocketing to 49. In January 2026, 8 weeks ago, it crashed from 121 to 74, and 12 days later, it was back at 96. 12 days. If you sold at 78, you missed a 23% recovery in less than 2 weeks. And right now, at $84, the setup is not just similar to those moments, it is structurally superior. Because in none of those previous bottoms did you have Citigroup publishing a $150 target. In none of them did Bank of America have a $309 research note. In none of them was COMEX registered inventory at a 20-year low. In none of them was a shooting war closing the world's most important oil and bullion transit routes simultaneously. And in none of them had JPMorgan just taken delivery of 8.1 million ounces of physical silver in a single month. The people telling you to panic right now are the same people buying your metal. And by the end of this video, you will understand exactly why selling silver at $84 in March 2026 could be the financial decision you regret for the rest of your life. Let me show you how the panic machine works, because once you see the blueprint, it loses all its power over you. Step 1, engineer a crash. The CME raises margin requirements. This forces leverage traders to sell whether they want to or not. The selling creates a cascade. Algorithms trigger stop losses. Stop losses trigger more selling triggers panic. The price drops 10, 15, 20% in a single session. This has happened 5 times since December. 5 margin hikes, 5 crashes. The pattern is so consistent that you could set your calendar by it. Step 2, amplify the fear. Within hours of every crash, the financial media runs the same headlines. The silver's rally is over. Is precious metals momentum broken? Time to take profits. CNBC ran a story this week calling gold, silver, and South Korea the momentum trades of 2026 that are breaking. Breaking. Not correcting. Not consolidating. Breaking. That word choice is not accidental. It is designed to make you feel like the entire thesis is dead. Step 3. Buy the metal you just sold. While retail traders are liquidating in panic, institutional players are standing for delivery on COMEX. January, JPMorgan took 99% of all delivery notices. February set an all-time delivery record. March has 52 million ounces standing. The institutions are not selling. They are accumulating physical metal at prices that their own margin systems helped create. If you're watching this and you almost sold today, or you did sell, subscribe and hit the bell. Because understanding this machine is the difference between being the person who panics at the bottom and the person who recognizes the bottom for what it is. Now, let me show you what the data actually says versus what the headlines say. The headline says silver crashed 30% from its all-time high. That is technically true. Silver went from 121 to 84. But let me give you the context that headline deliberately omits. Silver was $28 in January 2025. It is $84 today. That is a 200% gain in 14 months. A 30% pullback within a 200% rally is not a crash. It is a textbook correction within a secular bull market. Every major bull run in every asset class in history has experienced 30 to 40% corrections along the way. Amazon pulled back 40% 4 separate times during its rise from $10 to $3,000. Nobody calls those crashes. They call them buying opportunities. Silver at 84 after reaching 121 is the same pattern. And here is the number the panic machine doesn't want you to see. Silver's 50-week moving average, the trend line that institutional money managers actually use to determine long-term direction, is at $62 and rising. Silver at 84 is 35% above its long-term trend. That is strong. That is bullish. That is the opposite of breaking. Now let me show you what happens to people who sell at moments exactly like this one. because the data on this is devastating. After the 2020 COVID crash, silver dropped to $11. Retail investors panicked and sold. Within 18 months, silver was at 30. The people who sold at 11 missed a 170% rally. After the January 2026 crash, silver hit $74. Reddit threads exploded with people saying, "I sold everything at 78, I'm done." 12 days later, silver was at 96. Those people sold the bottom of a move that recovered 23% in less than 2 weeks. And here is the pattern that should terrify you if you're thinking about selling right now. In every single crash, the people who sold were responding to the same emotions, the same headlines, the same media machine. They felt the same fear you're feeling right now. And every single time, selling was the wrong decision. Not sometimes, not usually. Every time during a structural supply deficit. Why? Because the fundamentals don't change when the paper price drops. COMEX didn't magically find more silver when the price crashed to 74. The supply deficit didn't close when margins were hiked. China didn't reverse its export controls when Bloomberg ran a "silver is breaking" headline. The war didn't end when CNBC produced a segment about momentum trades failing. Everything that made silver worth $121 in January is still true today. The only thing that changed is the paper price. And the paper price is controlled by margin policy, not by supply and demand. Let me make this concrete. There are 86 million ounces of registered silver in COMEX vaults right now. That is a 20-year low. There are 52 million ounces standing for delivery this month. Industrial demand is consuming over 1 billion ounces a year. Mine production is flat at around 850 million ounces. The deficit for 2026 is projected at 67 million ounces, the 6th consecutive year of shortfall. The cumulative deficit now exceeds 820 million ounces. These numbers do not care about your emotions. They do not care about margin hikes. They do not care about CNBC headlines. They describe a physical reality in which there is less silver available every single month, while demand grows every single quarter. And at some point, a point that the banks have already identified in their research notes at $150 to $309, the paper price has to reflect that reality. The question is whether you will still be holding your silver when it does. When silver crashed on January 30th, the financial media told you it was because of Kevin Warsh's nomination. Sell your silver, the Fed is going hawkish. What they didn't tell you is that JPMorgan covered a massive short position at the intraday bottom, the exact bottom of that crash. They bought while you sold. And when silver crashed on March 3rd from 96 to 82, the media told you it was a momentum unwind. Sell your silver, the trade is over. What they didn't tell you is that COMEX delivery data shows institutions standing for record physical delivery in the same week. They are demanding real metal while telling you the paper price is headed lower. When silver pulled back this week, CNBC's headline was, "The momentum trades of 2026 are breaking. Sell everything." What they didn't tell you is that Citigroup, which is owned by the same financial ecosystem, published a $150 target that same week. They published crash headlines for retail and bullish research notes for institutions. 2 stories, 2 audiences. One transfers wealth to the other. This is the question I want you to sit with, and I want your honest answer in the comments. If the banks genuinely believed silver was going lower, if they truly thought 84 was expensive, why are they taking physical delivery at record volumes? Why is JPMorgan accumulating millions of ounces? Why did Citigroup publish 150? Why did Bank of America publish 309? Banks don't publish bullish targets on assets they're trying to avoid. They publish them on assets they're trying to accumulate before the price reflects the target. You are the other side of that trade. Every ounce you sell at 84 in a panic is an ounce. An institution buys at 84 with a $150 target. Your fear is their inventory. Your panic sell is their discounted entry. And the margin hikes that created your fear were implemented by the exchange where they are the dominant dealer. This is not a conspiracy theory. This is the structure of the market operating exactly as it was designed to operate. The question is whether you understand it well enough to stop being the exit liquidity. Let me tell you what. I would want someone to tell me if I were sitting where you are right now. Watching my silver position bleed, feeling the pull to sell, wondering if the people calling for $50 are right. Nobody can promise you that silver won't go to 75 before it goes to 150. That is a real possibility. Margin hikes can push the paper price lower in the short term. The dollar could strengthen further. The war could de-escalate and reduce safe haven demand temporarily. These are real risks, and I will never pretend they don't exist. But here's what I can promise you, because it is not a prediction. It is arithmetic. The supply deficit is real. 820 million ounces of cumulative shortfall. That metal does not exist. It was consumed. It is gone. No margin hike brings it back. No headline recreates it. The deficit is a physical fact that grows larger every quarter. COMEX vaults are at a 20-year low. 86 million ounces of registered silver. 5 years ago, there were 240 million. 64% has been drained. That drainage is accelerating, not slowing. China has gated 60 to 70% of the world's refined silver exports through 44 companies. That is a structural choke point that did not exist 12 months ago. Dubai, 20% of global bullion flow, is shut down by a war with no end date. The Strait of Hormuz is closed. The physical supply chain is fractured at every node simultaneously. And every major bank with a research department has published a target that is 2 to 4 times the current price. The people selling right now are selling into this reality because a number on a screen moved in the wrong direction. They are making a permanent decision based on a temporary price that is set by an exchange that changes the rules whenever it wants. In 2020, people sold silver at $11. It went to $30. In January, people sold at $78. It went to $121. Both of those panic sells happened during supply deficits. Both happened during media-amplified fear cycles. Both happened when the margin machine was running at full speed. And both were catastrophically wrong. Here's what's in your control. Not the price, not the margin policy, not the headlines. What's in your control is understanding the difference between a paper event and a physical reality. The paper event is a $12 drop in a day. The physical reality is that there's less silver on Earth than there was yesterday, and more demand for it than there was last year. Paper events are temporary. Physical realities are permanent, and permanent realities always win. You didn't buy silver because of what it would do this week. You bought it because of what it represents in a world of $38 trillion in debt, a captured Federal Reserve, and a monetary system that prints its way out of every crisis. That thesis has not changed. The deficit has not closed. The vaults have not refilled. The banks have not lowered their targets. Silver at $84 is not a reason to panic. It is a number that the most powerful banks on Earth are using to load up on physical metal before the rest of the world figures out what they already know. Don't give them your silver at their price. That is exactly what the panic machine was built to make you do.